Welcome back, everyone. Really looking forward to today's call. We're going to be covering a lot of interesting topics that a lot of you have expressed some interest in, namely inflation, supply chain disruption, the direction of the interest rates, and what kind of an impact that's going to have on our housing market, Bitcoin, post-COVID opportunities. So lots of interesting areas. Joining us on the call is Marchello Holditch. Marchello is a key member and decision maker of our CI investment committee, where he's been sitting on the board there for the past 10 years and helping serving us in many different important ways to keep the portfolio going in the right direction. So part of that is, carefully selecting the right portfolio managers that make up your portfolio, having a constant review with them, monitoring their performance, and if need be, replace and take a different direction with that. Basically, also giving us the latest in terms of analytics, the trends, how we should be repositioning the portfolio with various different sort of ebbs and flows with global markets in general. So essentially, more of what you need and less of what you don't is what he and his team are really in charge of doing for us on the portfolio standpoint. So it's a massive job. It requires 24/7 supervision. It is impossible for us to be your wealth and life advisors, making sure that we take a look at everything that goes on in your life and your overall financial situation if we don't have a dedicated team that looks at all these different areas for us constantly. So with that said, Marchello, thank you so much for taking time out of your busy schedule to join us today.
Thanks for having me. It's a real pleasure.
So why don't we start off with inflation? And that's really at the forefront of a lot of people's minds. Whether we're purchasing a car or whether we're looking at doing a home renovation or buying a property or even just something basic like simple grocery shopping, prices have definitely moved up. And I'm sure you're going to be talking as to what has caused these prices to move up. But more importantly for us and what our clients really wanted to know was, is this more of, you think, a situation that's going to be long lasting, that is going to be with us, and this new normal, this new higher inflation that we need to possibly make some adjustments to the portfolio? Or is this something of a temporary nature that will eventually correct itself on its own?
It's a great question, and we've been thinking a lot about it. And really, if you look back over the past 30 years, we haven't talked about inflation much. If we looked at the last 30 years, it has been a rather benign inflation environment, and especially the last 10 years, inflation really only averaged 1.5%. And now we're seeing inflation at 4, 5, 6%, depending on the time period you're looking at, depending on the country that we're talking about. So you're right. It's clear that we're in an inflationary environment right now. We feel it at the pumps, at the grocery stores, et cetera. But the real part of our job is to figure out exactly the question you're asking is how long is it here to stay and where are we going? So the first thing we do to get to that answer is analyze the forces behind it. So what is causing that inflation? And really inflation is coming from 3 different areas. So the first is scarce goods. So because of the pandemic, you had factories shut. You had different areas of the market. So semiconductors, for example, was an issue, and then that had knock-on effects to the auto manufacturing market, et cetera. So there's a lot of a problem of scarce goods because of those supply chain issues. So when we look at that, we do think that those are transitory. Now, what does transitory mean? But we still think it's going to take 12 months for those supply issues to get figured out. So we think that those are a transitory part of inflation. Those supply chain issues will be worked out, but it'll probably take 6 to 12 months. So it'll still be an issue in 2022, but not so much in 2023. So we think the effects of that pandemic and scarce goods are going to come out. The second issue is scarce workers. So there were scarce workers for a number of reasons. Some just in general were fear of working for health concerns. Others had to stay home with children, and others just chose not to work because they could receive benefits for staying at home. So there's a lot of different reasons, but we also think that scarce goods is going to play itself out probably over the next 3 to 6 months as well, because now most governments have ended those subsidy programs. You now have schools are back open, and those benefits aren't quite as generous. So again, that's a transitory piece of inflation where those scarce workers we're driving up the cost of certain things, and we think that that's going to subside a little bit. And then the next part is excess demand. So excess demand is just people weren't able to spend. So you had people during the pandemic that weren't able to spend, and now you have a lot of pent up demand. And now that people can spend, the stores are open, they're going out and spending. So there's certain things you can't multiple spend on. And the best example I give is a haircut. If you didn't have one for a year, you're not going to have 12 haircuts just because you didn't have one for a year. But there is a lot of goods where there's things like going out for dinner. Maybe you only went out for one time a week before, but now there's a lot of pent up demand to meet up with friends. So things like that, there is excess demand at play here in certain facets. So that's somewhat transitory as well. But there is areas, and one of the areas that we're looking at, in two areas that tend to be stickier, and that's the sticky inflation component. So people talk about headline inflation, and then there's core inflation, which excludes energy and excludes certain foods. But there's really then what we would call not transitory inflation, and a lot of that has to do with two things: wages and rent. So wages tend to be sticky. So that's one thing we're monitoring very closely, is wage growth. So it has been higher than normal, but still not out of control. So that's something that we're keeping a close eye on, because that would change our view. So our view in summary right now is that inflation is going to be transitory. We're at 4.5 now. Next year, it'll probably go down to that 3% range, and then probably close to that 2.5 and long run in 2023, 2024. But the risk to that could change is if we do see wage growth get out of control. And right now, naturally, when the economy reopens, when there is a scarce amount of workers out there, or at least they don't match the skill set, you're going to see some wage inflation. We're watching that doesn't get out of control, and hasn't yet. And the second thing is the flow through of housing prices in terms of rent. So there's something called owner's equivalent rent, which is a big part of the inflation numbers. And really, that hasn't flowed through yet. It takes about 18 months for house prices to go up, and then slowly rents start getting increased, and that inflation component of homeowners equivalent rent starts to spike up. So we could see that starting to be, it hasn't been a factor yet, but we think it's going to be a contributing factor, but it'll probably take 12 to 18 months for that to be a contributing factor. So it's wages and housing that we're really looking at to get a handle on inflation over the long term. Some of these things like chips and gas, just like lumber we saw last year, we think those are transitory inflation factors that are going to normalize next year, but we are keeping an eye on some of these other things.
Yeah, fantastic. And, we've seen the images. I don't know if you have, I'm sure you have, but even certain things like cargo ships and vessel ships, right? So even in the ports of California, for example, where you're looking at how long is that waiting time? So there's 4 times the amount of ships carrying hundreds of thousands of containers waiting to be undocked, waiting to be delivered to the warehouses and finally to the consumer. So yeah, 4 times the amount of that last year. So obviously it will have some kind of transitory issues with inflation for sure. So no, great input on that. Thanks for that. I guess that ties into interest rates, because we were just talking about the housing market there as well too, right? And how you're looking at that and wage growth as two of the catalysts to really see if inflation is going to be a problem here over long term. So, interest rates, they have started to move up a little bit over the last 4 or 5 weeks. There's no denying it. Mortgage rates have moved up a little bit. So that's also something that's been asked of us in our meetings is this something that will start to get even more aggressive here in the shorter term? And we've heard banks come out and saying that rate hikes are going to take a shape of about sort of 8 different rate hikes over the next 2 years. So you hear stuff like that, and you start to think, okay, well, how is that going to impact mortgages? How is that going to impact the housing market? Will it lead to a correction eventually in the housing market, which is not good for a lot of people, great for some people holding cash and ready to redeploy some of that cash and maybe an investment property? So if you could just give us sort of your take on that. Interest rates, are they expected, in your view, to go up aggressively, gradually, maybe not at all?
Yeah, that's great. And I'll give you our outlook on interest rates, and then I will tie that into the housing market as well, because you're correct. It is very, very much linked to the housing market and mortgages in particular. So we do think that rates will eventually rise, but we do think that the key here is that they're likely not going to rise quickly. And even more important is not to too high of a level. So right now we're at 0% interest rates. what is that level that we think is quote unquote normal? It's probably somewhere around 2%. So that's about where we got in the last cycle. Really, interest rates only got up to overnight rate close to 2% before we had to cut and go back down. So interest rates are going to go up. We think they're going to go up there slowly, probably less slowly than the market's pricing in. So the market's pricing in, especially in Canada, 5 interest rate hikes next year, or 4 to 5, depending on when you looked at it in the last couple of weeks. We think that's quite aggressive, given that the economy still isn't quote unquote at full capacity. So for the central bank to raise as much interest rates as much as the market is expecting right now, we think that that's a little rich. So we've actually been taking advantage of that and doing things inside of our portfolio to take advantage of the fact that we're likely not going to see interest rates rise that quickly. So where does that take us? Yes, there is going to be small mark-to-market losses on fixed income in a slowly rising interest rate environment. But the key here is that when you have that rising interest rate environment, higher interest rates actually is better for your longer-term fixed income return. So in the short term, rising interest rates hurts those fixed income returns, but in the long term, it's actually beneficial because you want to compound at that 2% rate, not at that 0% rate. So we think it's actually healthy. And what we have to worry about is if interest rates rise too quickly, and that's why we think the central bank's going to be cautious. I think the market can take slow and steady, methodical interest rate rises back to that 2% point, and will likely take us a few years to get there. And if we do that, we can do it without materially slowing the economy, and also without materially hurting the real estate market. So the real estate market, mortgages, you tell me fixed rates you've likely seen if you tried to go in the last couple of weeks, they're higher than what you could get in the summer. And that's because mortgage rates are tied to the Government of Canada, short-term Government of Canada bonds. And short-term Government of Canada bonds have started, yields have started spiking, and that's why you're going to see those fixed rate mortgages go up in value. But again, go up in value to what? You've seen interest rates as, quoted as 1%, 1.5%. Will they go back up to 2, 2.5%? Yes. Are we going to see anything higher than that in the mortgage market? I would say that's highly unlikely. So rates are going to go up, but not up to the point where it's really going to have a significant impact on the market. So if you ask me where I think house prices are going to go, it looks like there's still strong demand, even now that the pandemic's over. In the residential market, for certain in real estate, even though the pandemic's over, there's a lot of this flexible working environment, working from home. So I think that's going to keep supporting demand. And then the supply side is going to be okay as long as interest rates don't rise too fast. And if I look at prices in the last year, depending on the city, it's different. But in Canada, they've been up on average 20%, similar number, about 20% in the US. Could we see a correction in prices with those slow interest rate rises? I think the answer is quite possibly. You could see some froth come out of the market, but I don't even think they're going to go down to the level they were a year ago. So they would effectively have to lose approximately just less than 20% to be at the level that they were last year. So could you see some froth come out of the market and maybe you see prices down a couple percent? It's very possible, but I think it's highly unlikely that you're going to see a major correction that brings us to pre-pandemic prices. So if you have cash and it's sitting on the sidelines, I often say the best time to invest is yesterday, because of the power of compounding and not knowing when things like the COVID crisis could happen. You could see some small, low single-digit losses if you were to buy now. But if you have that time horizon, I think 3 years from now, 5 years from now, house prices are going to be a lot higher than they are today. So it really has to do with that time horizon and how much is there. I don't think in the next year, what's our base case? I don't think you'll see 20% house price rises. I think it'll be smaller. You could see 5% losses, or on the gain side, you could see 5 to 10% gains. I just think it's going to be a lot more muted market in a base case scenario. And there is the outside risk that there's a big correction, but in my opinion, that would have to take the central banks really mismanaging their mandate of trying to keep stable prices and really rising interest rates too much too fast.
Yeah, so it's not like your typical where your interest rate and increasing them is your tool to offset inflation in a normal functioning right? Market or a normal functioning economy where we're starting to see sort of rapid inflation. This isn't really the case, right? It's more the economy is by no means in a mature state. It's still growing, but not in those like past typical cases where, you know, it's necessitated where the government has had to come in and higher interest rates. So that's encouraging. So that's good. So we have to basically wait and see how things are going to be playing out and adjust accordingly, right? So that's good. Interest rates tie in very closely to currency and our dollar as well. And in past, with currency, that is a pretty close tie with how high or low the interest rates is to the domestic currency. So that's also a question that our clients have is what's the direction of our Canadian dollar vis-a-vis the US dollar? We have quite a few clients that have businesses set up where they are getting some US dollars. And so that is sensitive for them. Also, we have clients that like to spend a lot of their time, whether vacationing or whether doing business in the States or retiring, spending part of their retirement in the States too. So they're always interested to hear, okay, well, is 80 cents of where we're at right now a pretty fair exchange rate, or is that expected also to rise or drop going forth here?
Yeah, it's a great question. It's something we look at a lot, especially because of our investments being global and a lot of the global equity market being domiciled in the U.S. We really look at that cross currency rate between the Canadian U.S. dollar. So I would say right now we actually are fairly neutral and think that we're close to where the fair value is, and it's really because we're being pulled in two different directions. On the upside, we're seeing really strong global economic growth. So when you have a global economic expansion, currencies like the Canadian dollar tend to do better than the US dollar. And so we do think you're going to see above trend growth in Canada and much of the world next year. So that's going to be a good tailwind for the Canadian dollar to do well. The second piece is energy prices. So the energy market is not as big a proportion as maybe sometime in the past of the Canadian economy, but it still has a lot of knock-on effects on the Canadian dollar, and we're seeing elevated oil and natural gas prices. So we think that's going to support the Canadian dollar over the short term. So with this risk-on environment and these elevated energy prices, I think that's going to support the Canadian dollar over the short term. And the last piece is that our central bank has been more aggressive than that in the US in talking about interest rate hikes. And so if you look at what's priced into the market, right now we're pricing in 4 or 5 interest rate hikes for Canada and only about 2 in the US. So that's really supporting the Canadian dollar right now. So if you say, what's my short-term view in the next couple months, I think the Canadian dollar is well supported. 80 cents is the fair value, and you could see it even go up a little bit. But I do think over the next year, so in 2022, I do think you will see the Canadian dollar drop. And for the very reason is what I mentioned before, is that right now the market is pricing in aggressive hikes by the Bank of Canada and a lot more hikes than the US. So we look at that differential of what are short-term interest rates in Canada versus the US. Right now, they're a lot higher in Canada than they are in the US, historically, more by a historically wide amount. And when we look at that spread, the Federal Reserve only raising twice and the Bank of Canada raising 4 or 5 times, we think it's really unlikely that the Bank of Canada is going to raise interest rates that much more aggressively than the Federal Reserve. So we're fairly neutral on the Canadian dollar because we think it's probably going to rise a little bit over the short term. But then as the Canadian Central Bank might disappoint on providing that many interest rate hikes, and then you'll see the Canadian dollar come back down.
Okay. So our loony is a little loony, but not too loony, basically, right?
Yes, exactly. It is, and just one last point is longer term fair value is 80 cents. Now, when you say what's longer term fair value, we look at purchasing power parity and what makes a price of goods in Canada versus the US equal, and around 80 cents. It makes a common basket of goods about equal price, whether you go to Canada or the US. If you went to the US when we were at parity, everyone be going crazy shopping in the US because everything was cheaper. And then when we were at 60 cents, no one wanted to go to the US because everything was more expensive. That 80 cents is near that long-term fair value. So just taking even a more long-term view, if you plan on and you do have a more longer-term view, this is a good rate to do an exchange. It's definitely a fair value at 80 cents.
Switching gears a little bit, let's talk a little bit about the markets in general. So post-COVID economy, we've seen, the last 18 months, we've gone through a lot, obviously, with the pandemic. We've learned a lot of lessons. Companies have showed a great deal of resiliency of how to adapt, how to pivot, how to take advantage of the massive thing that is the internet and technology. We were in a lockdown. We couldn't go to a restaurant, but the restaurant came to us through Uber Eats. We weren't able to see you, Marchello, live, and you weren't able to, do various business trips live, but you were able to do a lot of this through the Zooming of these video platforms, right? And this whole market that pretty much got birthed or got emphasized even more over the last 18 months. So just curious to hear your take as to these post-COVID opportunities, their trajectory, projection, versus the older economy, the more stable businesses, the ones that we like to invest a little bit more, the more blue chip, the more stable ones. Are they going to be moving in vastly opposite directions over the course of, let's say, over the next 10 years? Or is this really the new flavor that we've been sort of tasting the last 18 months here to even take more place in our economy?
Yeah, and that's a great question. It's something that we've been wrestling with. I would say a lot of those, the short answer is a lot of those companies that maybe are your more traditional companies, those ones that do digitize themselves and position themselves better for the new economy, I think are still going to be good investments. Unfortunately, in that bucket, there is going to be companies that aren't going to do well in this other environment. But just because a company is in that more traditional company or more traditional businesses doesn't mean they can't do well. I think they can if they make that digital transition. And that's where we do employ a lot of underlying managers that will screen those companies and make sure they're getting those ones that do employ that are employing a strategy to deal with the digital age. So we have a lot of investment managers that have a strong track record of identifying those companies and making sure we're invested in those companies that are taking advantage and not just coping with it, but I want to say taking advantage of that shaping in the digital world. You hear a lot of analogies to the 2000 tech bubble, and really I think a lot of those are unfounded because back then, a lot of these things were in their infancy. A lot of the big technology companies now have viable businesses, economic moats, they have sustainable cash flows and growth profiles. So it's much different than investing in the year 2000 when technology was just coming on. A lot of these are mature, stable businesses that I think are going to do well, but I wouldn't abandon those other businesses, especially if they are digitizing themselves and becoming more and more up to date. And really two trends, and two of the biggest trends we're seeing companies really react to is digitization. So knowing that digital goods and services, more is happening online, more share of sales are going to be online, and the pandemic really accelerated this trend. So we're seeing a lot of traditional businesses start to pivot and take advantage of that, and I think those will do very well. And the second big theme for the next decade, other than the digitalization, is the decarbonization. So we just had a summit, and there is a secular shift away from fossil fuels and emitting carbon, and major governments are already introducing initiatives. There's a lot of pressure from pension plans as shareholders and companies like ourselves in CI in pressuring these companies to become more sustainable. So those companies that do become more sustainable, do digitize themselves, I think are going to do very well over the next decade, as well as those that are in that area itself.
Yeah, that's a whole other area too, right? Just everybody's talking going a bit greener, which is great for the planet. It's great for business, right? It talks the bottom line, and where the money goes, usually that's where activity tends to go as well. And that's interesting too. We were on a call just recently with a global equity manager that talked about all the massive opportunity in that. And doesn't necessarily mean just investing in those companies with the latest technologies. It's just something as simple as heating, ventilation, air conditioning systems, people returning back to work from post-COVID. Now, all of a sudden, there's a little bit more emphasis to cleaner air in the office. So that happens to be a good thing from an energy consumption standpoint. It helps to add to the bottom line if you're a company and looking at expenses, and it helps out the planet in the end. So win-win-win on multiple sort of facets there. So yeah, that's definitely interesting to see how this will play out here over the next little bit. Another topic, so this is a little bit different, and you were just talking about infancy and how, you know, the internet was in an infant stage years ago, and this doesn't really compare. So infancy, Bitcoin, you know, it's no longer an infant. We have seen this beast take its shape, and good and bad. And so that's often something that is brought up in our client meetings is, you know, not just Bitcoin and cryptocurrencies, the expectation, the growth rate with sort of that market and that sector, if it is even a sector, an investable sector at this point, but even certain other things that are circulating, like the trading platforms of Bitcoin, promising someone to become a millionaire within 3 to 4 months. I've seen the headlines on this circulating social media and the internet. So is there any validity to any of these kinds of claims that are out there? How real is cryptocurrency? Should we be investing a little bit more in cryptocurrency or crypto ETFs, for example? Just your view on that, please.
Yes, yeah, and it's interesting because it is something that you can't ignore. We do consider cryptocurrency effectively an asset class, and I think it's an asset class that's here to stay. And like most asset classes, I wouldn't paint them all with the same brush. So there's meme coins that Elon Musk talks about, for example, and then there's Bitcoin, there's Ethereum. So I think as an asset class, it's definitely here to stay, and we definitely need to analyze and think about it. And there's definitely going to be ones that are good versus bad. So you have different ones like Bitcoin. I think Bitcoin's going to have some challenges from the regulatory environment because it's in a way trying to replace fiat currency or the Canadian dollar or the US dollar. So there's still some regulatory headwinds there. And that's what I think is really capping the use of it. Others are more interesting to me, like Ethereum, for example. I look at that more on blockchain, more as an investment in technology or a technology company rather than an investment in a medium of exchange like a currency. So there's even cryptocurrencies that can do a lot more than just be currencies. And I think those are the most interesting. But at the end of the day, they're a very highly volatile asset. And when you put them in our range of outcome simulators, you know, fixed income, a bad year is -5%, equity, a bad year is -30%. A bad year for cryptocurrency could be -80, -90%. So you really have to be able to tolerate that volatility, and anything that's that highly volatile, I take it back to our risk budgeting process, is that you can't own much of it. So I almost think of owning cryptocurrency, think of it like a call option where you buy, and what a call option is you just buy the right to buy a stock if the price goes up. So we think about cryptocurrency really in that manner where you put that money in, could you get 2, 3, 4 times? Yes, it is very possible, but it's also very possible that you lose 80%. So make sure that you only put a very small piece of your portfolio in it that you're willing to lose 100% of, because there is really high risk in it. And the last point I'll mention there is, and you sort of touched on it when you said, you know, some of these tech companies, it's not the year 2000 anymore, it's now the year 2020. We've had some time. I still think we are in the infancy of cryptocurrency because there's still those regulatory issues and there's still so many more new ones. And like we saw in the tech bubble, there was a ton of companies out there. Most of them, in actual fact, went bankrupt, and there was a small few of them that ended up being winners and are still around today and are the largest corporations in the world. But for every Microsoft, there was 100 XYZ name that you can't even remember and will never know about. I think cryptocurrency is a lot like that right now, investing in it. I think that most of them are probably not worth anything and are going to go to zero, but there will be a few winners, and those few winners, their returns aren't going to be 2, 3 times once they become more established, but they can provide a stable, steady return, much like you would think of from a technology company, for example. But even Ethereum, which has that blockchain technology, there's no barriers to entry. There's other currencies that are coming out now. So what that winning cryptocurrency might be over the long term, that 10 years from now we'll be looking back, might not even exist today. So we are in an area. It is an area that's growing, but it's still extremely risky. So we're not putting very much of our client assets in it. We do have some small investments in those cryptocurrency ETFs, but really our investment philosophy is about stable, steady, predictable returns, and not about gambling. So that 3 to 4 times return, you could go to the casino and get 3 to 4 times your money too. But the probability is that you're not. So that's all I'll say, is that it is possible. So they're not lying when they say put your money in and get 3 to 4 times. I'm sure it's very possible, but it's just not very probable.
Yeah, and that's really what we're trying to control, right? Is like these series of potential outcomes, like bringing up the predictability part of things, right? So, a lot of people look at the rate of return of Bitcoin since the beginning, and it lures them into potentially investing some of their money there. But a lot of them don't realize, like you mentioned, the potential 80% drop that happens, and that is real. I saw a chart not long ago that basically showed us the declines over the last since 2012. There have been 15 times where Bitcoin has dropped, not slight correction, but crashed 30% or more. So are you willing to stick it out? And part of the 30%, sometimes it's a couple of times where it's dropped 80, 90%, like you said. So a lot of the times you cannot stomach that, to be realistic, to go through that massive swing to eventually come out a winner. And so, we have so many different areas of opportunity to invest in. Why do we need to put more money into something that is still in its infancy stages, for sure, still unpredictable, and a lot of cases, a lot of these companies, like you said, a lot of these cryptocurrencies probably won't even be around for long term. So yeah, that's super insightful. I'm sure a lot of our clients are going to take back some of that what you said, and just find great insight with that. So just your general longer term outlook with regards to the market. So where do we go from here? Of course, there's a lot of headwinds, and we spoke about them, but there's also a lot of tailwinds as well too, right? That helps to keep things moving forward. So are we supposed to be really optimistic? Are we supposed to be conservative, cautiously optimistic over the next, say, 3, 5, 10 years in general for a portfolio that is well diversified, that is spread out pretty much across the world with regards to equities, that has maybe 20 to 30% in more stabilizing features like income and of the such? What can we expect in terms of a general kind of direction on things?
Yeah, I would say that we're not going to get obviously as much as we've got this year, but I think that we're still going to get in that type of portfolio a very strong, stable, steady return, and a lot of that has to do with the economic environment that we're in now. Obviously, there's the outside chance of a mutation in the virus and all that, but if we're talking long term, because even that, humanity would get over that and we would adapt. Long term, we are very bullish because you have accommodative central banks and you have accommodative governments now too. So that's something we didn't have over the past decade. Over the past decade, especially in Europe and in some different administrations that we had in the US, because there was political infighting, there really was more austerity where you had central banks with interest rates very low, but you didn't have governments really encouraging spending. And now we're seeing that's flipped. So now we do have the federal governments on side of stimulating the economy as well. And the central banks are still there. So you have central banks that are going to keep interest rates low. And now you have central governments that are starting to spend money on hopefully productive investments that are like infrastructure that are going to really increase productivity and provide and up that potential long-term economic growth. So I think we're seeing that. So there's a lot to look forward to in the next decade. And so that's where we think that the stock market is going to do very well, and primarily because of earnings. And that's one of the things we've saw in the last year. You think, oh, the stock market's up over 20%. How is that possible? Well, it was up to over 20% because earnings were actually up over 20%. So it's been a very healthy market. So it hasn't been driven just by valuation expansion. And that's the thing a lot of people are talking about right now. And when they forecast long-term equity returns that they say are going to be negative, they assume that it's because valuations are going to come down to some quote unquote historically normal level. Well, unfortunately, just like interest rates and most things and house prices and stock markets, there is no such thing as historically normal level. And so what we think is going to keep equity valuation supported and really still make sure that we have a strong positive return coming through from earnings. So if we get those positive returns coming through from earnings, it's going to be those low interest rates that keep valuations elevated. So as long as central banks keep interest rates low and not zero, as I mentioned, we think they're going to go up somewhere probably closer to 2% at some point this decade. But we think they're going to stay and not go much above those levels. And at those levels, it's very supportive of equity market and real estate markets and just asset valuations in general. So that's where we are quite optimistic on the next decade and think that you are going to get some strong positive returns, in particular from the equity markets.
That's awesome. I mean, so going back to what you said before, when is the best time to invest? Yesterday.
Yesterday.
That's
Yep.
what I get from all of this, is that it's not perfect. It's we're always going to have little bumps in the road, but sort of the future looks pretty bright, even with all of what we've been going through the last year and a half. So, you know what, this has been extremely insightful. I really thank you, Marchello, for taking time out of your really busy schedule to join us today. Hopefully the clients found this insightful as well. And I wish you a great rest of the day. Stay safe. Thank you, everyone, for sending us your questions ahead of time.
Take care. Thank you, everyone.